What is going on, guys? Welcome back to another brand new YouTube video. Today we're going to talk about institutional trading, and hopefully that is why you're here. But before we do that, a couple of things that I would like to mention. Number one, everything I've ever done on YouTube and on other social media platforms, I've always done it for free. So if anybody replies back to you in the comments, whether it's on Instagram, on my Instagram, or anybody contacts you via email, or anybody contacts you via message on Telegram or Instagram, or replies back to the comments in on YouTube, that is not me. Okay. And especially if the person is asking you to contact them and they can help you for a certain amount of money, that is definitely not me. Anything I've ever done is for free. It's always been on my YouTube. You can watch it, you can learn from it. I used to do mentorships, but I don't do that anymore. So I don't do courses as well. So basically, I've never asked anybody for money. Okay. So if anybody is getting in contact with you through my using my name, they are definitely a scammer. So please try to stay away from people like that. That's number one. Number two, I'm not a financial nor an investment advisor. Anything you see or hear on this YouTube channel is only for educational purposes. I am just sharing what I do in my daily trading life, or whenever I trade, and whatever you choose to do with this information is entirely up to you. I am in no way held accountable for your actions. Trading is a very risky business, so if you want to jump into this online trading world, please make sure you do your own research before giving it a try. Now that we have all that stuff out of our way, let's talk about a couple of trades that I called out over a course of 7 days. Okay, so the very first trade that I want to talk about is the one that I called out on my Telegram. I believe I sent this out to my Telegram, Euro USD. It was on the 18th of November, if I remember correctly, which was, yeah, so 18th of November. I will show you guys the before picture, and this is, of course, the aftermath of what happened. As you guys can see, Euro USD, November 18th. You guys can see the time over here, 60-minute time frame, and this blue line that you see is where my entry was. Okay. Now let's talk about why I was looking at this area for entry. There's a wick. So a lot of you might have the same question, which is why you are entering on a wick, right? So let me go ahead and tell you guys exactly why. So I believe I dropped down to the 15-minute time frame, but before that, let me see if I can go back in time and show you guys what happened on the 5-minute time frame. Okay, so on the 5-minute time frame, what you guys can see is the last push to the upside. First of all, I want you guys to look at this, and then I'll tell you guys why I was looking at this area for an entry. Okay, so first, you guys need to see that the big institutions, whether it be banks or investment firms like hedge funds or whatever, right? The big institutions, they bought the last time. They bought over here for a sell. So you guys can see how the market was just ranging, right? So we know that the institutions have not yet entered the market. The institutions enter the market whenever there's a big move. So the big move is usually the institutions are behind that move. And what do you guys see over here? After that last buy, what do you guys see? That impulsive move to the downside. Now this tells me that the institutions have entered the market. And this is where I would like to enter when the market comes back to this area, because they have to mitigate out of this position. They have a buy open over here. Remember, they have a buy open, which they need to close out in minimal loss. So they will, or break even. So they will come back to this position once again. And then that's where we would like to enter. Okay. So that's number one. We have our entry, last buy, last move up before the down move. Now this is on the 5 minutes. So if you go to the 15-minute time frame, basically you'll see the same thing. And let me just show you guys. So you guys see the last candle up, right? You guys see this blue line would, if you're entering off the 15-minute time frame, this would be a little bit lower to where the opening of this last candle is. So it would be somewhere here. this is where your entry would be if you're entering off the 15-minute time frame. If you would like to be more precise, you can drop down to the 5-minute and the 1-minute time frame. The reason why we enter off of small time frames is because it gives you a better risk to reward ratio. It gives you a small stop loss and a big or a decent margin for profit. Okay, so now that we have marked out that area, why did I choose to enter over here? What do you guys see over here? What do you guys see over here? Equal highs. What do you guys see at the bottom? We also have equal lows. Relevant equal lows. Not very precise, but we do have liquidity over here. Equal highs. Now, if you're using the indicator like the OBV, on balance volume, you guys can see that we have divergence over here. You guys can see we have divergence, right? The market is making equal lows, equal highs, right? Let me see if I can show you the divergence better. Exactly. So on the 30-minute time frame, you guys can see the market's making equal highs or relatively higher highs, but over here the market is making lower highs. So you guys can see that there's divergence. Now, whenever there's divergence, bearish, regular, or hidden, it means that the market is going to continue lower, right? So I'm going to wait for a spike. I know that there's a spike coming. So if you don't trade divergence, or if you don't use divergence as a confluence, as a confirmation, or as an indicator, let's say you use the Asian range breakout strategy, or the three phases of market cycle, which is accumulation, manipulation, and then distribution. So this is where the accumulation is. Then we have the fake breakout, which is the manipulation, and then we have the distribution. So let's say you trade that, right? Even if you trade that, no matter what you trade, you still can take advantage of this trade right here. So once I've marked that area out, I see liquidity. I know the market is going to do a fake stop hunt or a fake breakout. That's exactly what happens. Also divergence. Then I mark this area out on the lower time frame. In the future, when the market comes back to this area, now something very interesting happened over here. The market was almost 2 pips away from our entry, and this is why I don't use limits for my trading anymore. I don't use stop losses. I don't use take profits. I don't use buy limit, sell limit, and that is why, because I have my own reasons for that. It's personal preference, but whenever I'm in a trade, I always keep an eye on my trades. I always manually monitor all my trades and manage them. So if you cannot do that, if you don't have the time to do that, please use limits. Okay, that is the decent way of trading, or the professional way of trading. Don't be like me. I have all the time in the world. I sit in front of the computer all day. So that is why I always monitor or manage my trades manually. Anyways, so when the market comes back to that area, let me move this here. So when the market comes back to that area, what do you guys see? What do you guys see? The market comes exactly to that area, or 2 pips lower than that, and then boom, it just drops. Now, if you look at my TP is very realistic. Why is that? It's because we have the next area of liquidity is right here. So I know the market is definitely going to visit this area. Not only that, once I saw a market creating equal highs over here as well, I knew that the market is going to spike up, grab all these equal highs, come back into our area of entry, and then drop down. This is my favorite type of setup. If you guys have been on my channel for quite a while, you guys know that these are my favorite types of setups, where the market creates liquidity and then comes into our area of entry, because that is the most guaranteed trade that it's going to go into your profit no matter what. So that was a very good trade. Now, something very similar, if you guys have been trading institutional trading method for a while, you guys know that the market in an uptrend always does this, right? And this is where we enter, and that's exactly what happened over here. You have this boom and then drop, and then we enter off of this area, right? So that is exactly what I'm gonna show you guys. We had Euro USD. Okay, put this image right here into your brain right now. Okay, I'll give you 2 seconds. Did you do it? Okay, let's go to GBP USD. What do you see over here? This right here. This is GBP USD, and this is Euro USD. Same thing, right? Same thing. Now this trade, I'll show you guys a before picture. This is when I took the screenshot. I was looking at this area to enter, same thing. You guys can see 60-minute time frame, November 18th. I was looking at the market to come back to this area potentially and then drop down lower. Now if we go to our trade, you guys can see market. So I dropped down on the lower time frame. I think the 5-minute as well. Yeah, because it's not clear. Okay, so I couldn't even on the 1-minute time frame there was a wick. So what I did was I just took the close of this candle, and that is where I decided to enter. Now you guys can see this was not as precise, and it almost hit my stop loss. Almost. You guys can see I've not changed my stop loss, by the way. If you guys go to the picture, 1.33127, you guys come back here, 1.33127. And if you think my stop loss was hit, you can see the high of this candle. It says right here, okay? So the high of this candle is 1.33123. So 0.00004 pipettes is where it came close, but it never hit my stop loss. And then a nice little 1 to 5 risk to reward, almost 100 pips. Something very similar. Something happens all the time. Market starts creating this, and then boom, does the spike, grabs liquidity, fakes the breakout, and that is where we enter, where the market grabbed liquidity, where the market did the fake breakout, fake stop, or not fake, where the market did the stop hunt. Okay, this is where it's the stop hunts, stop losses are gonna be when the retail world is selling on this resistance. This is where the stop losses are gonna be. So once again, something very simple and very similar to Euro USD. Once I saw Euro USD, I just jumped to GBP USD. It was doing the same thing, so very good trades. Now the last trade I want to talk about was on gold. What a trade this was. What an amazing trade. I analyzed this trade on the 5-minute time frame, executed this trade on the 5-minute time frame as well. Let me show you guys the before picture. Here's the picture. I sent this in the Telegram as well. I believe many people took advantage of this trade. As you can see, November 24th, 3 days ago, 5-minute time frame, gold versus the US dollar. So why did I look at this area for entry? I'll tell you guys why. So let me delete this so you guys can see better. We have equal lows, right? Something very similar to the uptrend. In a downtrend, the market will start doing this. Boom, we'll do a spike to the downside, and then this is where we'll enter. But over here, we also have one more confluence. When the market did this, it also created a new higher high. You guys can see the previous high was over here, right? Or some people might argue that it's over here. That's fine. Regardless, if it does, even if it creates a higher high over here and over here as well, if it's a downtrend, it should just create lower lows and lower highs, right? But over here, you guys can see it starts creating higher highs and higher lows. That tells me that the institutions have entered the market over here. This liquidity grab and that huge reaction after that grab by this candle, this wick is what grabbed all the stop losses, and then boom, shot up, right? This is where we would like to enter our trade for a buy right here. Why did I choose the wick? Whenever there is a huge wick like this, more than 90% of the time, the market is going to come back and fill that wick. Whenever there's a huge wick, that wick has to be filled out. That's just something that came from experience. Nobody taught that to me ever. So whenever there's a huge wick, it is always going to be filled out. And especially when it's a sudden wick because of a news or whatever, it's always going to get filled out sooner or later. So I told my Telegram that I'm seeing the market starts to create lower equal lows over here. There's a liquidity, right? And what is my favorite type of setup? When market starts creating liquidity and then comes into my area of entry. That's exactly what happened. I told my Telegram that the market is creating equal lows, liquidity. If it comes down into my area of entry, to grab this liquidity, I will enter for a buy. My original TP was somewhere over here, which was around 250 pips, right? Or where was it? Let me see it. Oh, right here. which is very realistic considering that the market is going to go in an uptrend now. But I'll show you guys what happened. So over here, you guys can see the market came back into our area. So if this confirmation, you don't have enough experience, is not enough for you, you can see that the market finally broke out and created new higher highs. And this is where it all started, this last candle. Of course, I could enter over here on the start of this candle, but it doesn't give me a small stop loss. Over here, you can see I'm risking almost 14 or 15 pips for a stop loss, and I was aiming for 250 pips, which is in 1 to 17 risk to reward or something like that. But over here, we managed to get around 1 to 11, right? Yeah, 1 to 11 risk to reward. So you guys can see the trade maxed out at 100 and almost 160 pips, which is insane, right? Considering you're only risking 15 pips of stop loss and you're gaining 160 pips of profit. So that, my friends, is why we trade the institutional method or the institutional way, is because it gives you very minimal stop loss and a very decent margin for profits. So if you guys are new to this channel, I will drop a link to the playlist called Institutional Trading, all the videos I've ever done on institutional trading. You can binge watch all those videos. Trust me, it will blow your mind. I've done this so many times. There was a time when people used to question me, and that's understandable, right? Because not many people were familiar with this way, with these concepts. So I'm introducing something new to the market, and of course I have to prove myself. So if you guys want to see that, or you want to go to my Instagram, my results are always posted before, after. I've done this so many times. You guys can watch those videos. You will learn a lot, especially how the banks trade 1, how the banks trade 2, and then all the videos in order. Trust me, all these concepts, liquidity, market stop hunts, where we enter, mitigation, all that is mentioned in my videos. You guys can go ahead and watch that. And yeah, if you have any question, please drop them in the comments below. I'm always answering the comments. That is how you learn. So please do that. And yeah, hopefully you learned something new from this video. Hopefully this is motivating you to step into Forex and try it the same way, you know, try the institutional method. Hopefully I'll see you guys in the next video soon. I have a couple of ideas lined up. Also, we're going to do the giveaway, which I'm going to announce on my Instagram and my YouTube. So please go ahead and follow me on Instagram, Telegram, and YouTube, so you guys can take advantage of the $250 that I'll be giving away to 5 people, $50 each. And I'll do that in a live stream on YouTube. And yeah, that's it. Hopefully you guys enjoyed the video. I'll see you guys in the next video. Peace.